76 low to the 80 high, and then that next log scale move from 2001 to 2011 are precisely the same dimension on this chart. In other words, they're exact same ratio move, eightfold increase in price.
What Michael just revealed isn't a prediction, it's a 50-year pattern repeating. Every gold cycle follows the same rhythm. A quiet decade, then an explosive eightfold surge. At $4,000, gold's only halfway there. The next stop could be $8,500. Forget RSI or short-term charts. This isn't speculation. It's structural. When debt explodes and currencies collapse, gold becomes the only safe haven. And this time, the move could redefine global money itself.
Someone, they would probably think that there's something wrong with you because everyone would be so bearish on gold. So it performed quite well. So right now, from the technical perspective, I think if you look at RSI, it looks quite stretched. But fundamentally, a lot of factors that moved gold to these levels, they're still here. So what's your view on the current gold prices, and where do you believe they could go on?
I got a question. Vladislav, did you get the charts that I said, the logarithmic scale chart of gold and silver? Can you put that up? This shows gold in a ratio scale or a logarithmic scale of price, monthly closes. And it got legalized in the US in 75, and it was up at near 200, and it dropped into 76, down near 100. And then you had that bull move that took you up to the 1980 peak, which was like 850. Okay, so that was an eightfold surge, that first surge you see there, spanning several years. And then it languished sideways, but well above that near 100 low that occurred in 1976. And then you turned up in the year 2001 from a price level, which was about 265, by the way. And you surged all the way up to 1900 over the next, 10 years, different duration. But the move from the 76 low to the 80 high, and then that next log scale move from 2001 to 2011 are precisely the same dimension on this chart. In other words, they're exact same ratio move, eightfold increase in price. Okay. Again, then you went lateral from 2011 through 2023 with highs slightly above those of 2011, which is 1920. We got up into the 2000s, slightly above it, between 2020, 2021, 2022, 3, and it took off. But look at that last low in 2015, which was just above 1,000. Actually, it was 1,050. In order to match the logarithmic or ratio scale bull trends that preceded the two prior ones of the last 50 years, gold would have to go to 8,500. So when we see $4,000 gold right now, it's about half the dimension of the moves that occurred twice in the last 50 years. And arguably, the underlying fundamentals that exist and are yet to be revealed fully, which will be highly positive for gold. Why? Because monetary excess will go ape when the central banks get fearful about, one, their own debt problems, and two, their stock markets. Gold will be the prime beneficiary. In which case, going to 8,500, which sounds ludicrous when you think about an arithmetic scale, point scale chart. But on this chart, it's merely matching what it accomplished twice before in the last 50 years. Okay, so it's not even, it's doing the same thing again. It's not even excessive in that regard. And you mentioned RSI, by the way.
What Michael just showed isn't a random forecast. It's the same mathematical rhythm gold has followed for 50 years. Every major cycle, 1970s, 2000s, and now, shows the same pattern. A quiet decade, then an explosive eightfold surge. At $4,000, gold is only halfway through that historical move. The next logical target, based on ratio scale analysis, is around $8,500, the same expansion we've seen twice before. Forget short-term RSI signals. They mean nothing in a structural bull market. The fundamentals are far stronger. Record debt, currency debasement, and central banks trapped by their own policies. When they panic, gold becomes the only safe haven, and that's when it moves fast. We're not watching speculation, we're watching a historical pattern repeating. And this time, the outcome could redefine global money itself.
Same thing again. It's not even excessive in that regard. And you mentioned RSI, by the way. That's what we call a wet noodle momentum metric. If you go back and examine the price action late in that 1979 to 80 move, or between 2010 and 11 in that bull move, and especially this also applies to silver at that time, you could take your RSI charts and shove them because they got to such high levels and they stayed there for like 5 or 6 or 7 months. So in other words, it was overbought and stayed there. And in fact, during that period of overbought on RSI, if you got long and just stayed long, you made more money in that time period than you did during the entire prior bull markets. So once you got to overbought, which was normally a place to be cautious, in those situations, it's telling you, I'm lifting off. Okay. So if we get RSI up to levels that look scary compared to prior years, fine. It could very well be a sign that we're entering that phase where we're going to go ballistic. And
Yes.
particularly,
What Michael just explained destroys one of the biggest myths in trading, that overbought means it's time to sell. In reality, when gold enters its true bull phase, indicators like RSI stop working the way people expect. Back in 1979, and again in 2011, RSI didn't signal exhaustion, it signaled liftoff. Gold stayed in overbought territory for 6 straight months, and that's when the biggest profits of the entire bull run were made. So when traders panic about a high RSI today, they're missing the real message. It's not warning of a top, it's confirming a breakout. That's what happens when a market transitions from accumulation to explosion. If history repeats, this could be the start of that same ballistic phase, where gold and silver both go far beyond what traditional charts can measure.
over the decades, it's risen from what, you get 100 to 1,000, you go to near 10,000 to match it. So, okay. Here's silver, though. Logarithmic scale. You're now pressing at the high monthly closes back in 2011. And on 1979-80, we get up to $50. It doesn't show here because the high close then was in, I think, about 38 or something, but it intra-month got up to 50. So we're basically at the top end of a 50-year range, whereas gold is way, way beyond that. Okay. Now, so, I draw this horizontal arrow. It's like, so what? It's been in a range for 50 years. Like, what do you think it's going to do? Stay there forever? Okay. Gold's way out above its range. There is no range, in fact. It's a rising situation. And heck, copper is right now at 510 as we speak. Do you know what the high was back in 2011 for copper? I think it
No.
was above 460, I think. So even copper is above its 2011 high. Why should silver remain capped in a 50-year range? And if you factor in the real dollar spendable value of silver at $50 in 1980, silver at $50 in 2011, and factoring in the ongoing decay in the value of the US dollar, the real buying power, not its relative value to other currencies, silver probably have to be $200 right now just to match the conversion real value of the 2011 or 1980 peak. We think it's going there. We think silver's about to launch and catch up to gold. So instead of this horizontal arrow, I think you'll be able to draw one that's up.
What Michael just explained here reveals how undervalued silver truly is. While gold and even copper have broken far above their old highs, silver is still trapped inside a 50-year range, a range that's completely unrealistic when you factor in today's currency value. If you adjust for inflation, in the collapse in real purchasing power, silver would need to be around $200 an ounce just to match the true value of its past peaks in 1980 and 2011. That's why Michael calls this setup the biggest play of the year. Silver isn't just lagging, it's coiling for a breakout to finally catch up with gold. And gold at $8,500? That's not hype. It's simply the same proportional move it made in every major cycle before. The only difference now is the global scale of the crisis. A worldwide debt bubble, collapsing currencies, and the destruction of real money value. Gold doesn't just rise because of fear, it rises because fiat currencies are quietly dying. A dollar today buys a fraction of what it did 25 years ago. The S&P may look higher in numbers, but when measured in real buying power, it's lost ground. Gold, on the other hand, has preserved and multiplied purchasing power 16-fold since 2000. This is the harsh truth most investors ignore. You're not getting richer, your money is just becoming worth less. And gold and silver are the mirror reflecting that decay.